I'd like to welcome Manish, NRDC's CEO and President, who's going to open the event with some framing remarks.
Great, Carolina. Thank you so much. Good afternoon, everyone. You can hear me well, right? Yeah, great. Just super excited to be having this conversation with all of you today, an opportunity for us to talk in depth about the critical role that green banks can play in helping advance an inclusive, equitable, clean energy transition, not only here in the United States, but worldwide. We have a great set of folks in the room today, as well as online, folks from the private sector, the banking industry, asset managers, project developers, folks from government, state and local agencies, folks from civil society, donors, NGOs, academics, a really nice mix of folks from around society. But what I wanted to do in the opening is actually take a little poll of all of you in the room and kind of get a sense of the room on just a few questions that I think are top of mind here as we are in the middle of climate. So I just kind of a very simple show of hands. I want to start with a sense of the room around how goes the battle against the climate crisis. How many of you feel we're making some progress? 1.5 is tough, but still well below 2 degrees. We're seeing some good momentum. If things go well, things are moving in the right direction on the climate challenge. So how many of you feel kind of well below 2 is still in sight? We can make it happen. Raise your hands. How many of you feel that feels a little overly ambitious at this moment in time, and we're going to need to do something radical? So kind of 1/3, 2/3 on the climate piece. So the second question I want to talk about is kind of finance, right? Everyone here knows the conversation on finance is absolutely critical to tackling the climate crisis. We need, significant levels of public finance. We know we need to unlock private finance at scale. We know that that we need to get finance into places that it doesn't naturally flow, and that partnerships are going to be absolutely critical to make that happen. A lot of momentum in the finance space over the last few years. Are we moving in the right direction on finance? Are you feeling good about that? Yes. A little more than half, and no, not yet. Okay, so stronger on finance, a little less on climate. Last question, when it comes to finance, do you feel we're moving in the right direction and getting issues of inclusion and equity embedded into how we look at finance? Are we moving in the right direction, kind of broadening how finance works so that it works for those that low-income, vulnerable, frontline communities? How are we doing on the equity dimension of finance? Moving in the right direction? No one raised their hand, and I suspect we have a lot more work to do. You all know it's fairly obvious to tackle the climate crisis, which there's a lot more to do. We got to get finance at scale, public finance, private finance, and we know if we're really going to do this well, we need to get the inclusion and equity dimensions in. So we got some work to do, and that's what today is all about. It's about the role of green banks and the role that green banks can play, both to help us unlock kind of finance, private finance, the role that public finance can play in leveraging the scale of private finance we need, but also the role that green banks can play is the plumbing, the financial, the ability to actually identify, reach local markets, the knowledge, the networks, the projects, the people that we need to reach. We have 2 panels today, one a little bit more focused on the United States, second one a little bit more focused globally to explore these themes. And we're operating here as we are in New York in the United States with some momentum on these issues. All of you know about the Inflation Reduction Act, probably the single most important policy and public investment action, not only in the United States, but actually in the world, right? People say 370 billion, potentially up to $1 trillion of what we could actually see. And a key piece of that is the greenhouse gas reduction fund. You all know this, $27 billion, quite significant, a very strong focus on kind of low income and marginalized communities, potentially 70% of the funding going into that space. The fund could potentially generate 1 million jobs, according to a study by McKinsey, a good chunk of those in low-income communities. And most of you may have seen in the news today that the Treasury Department released guidelines for the financial sector about net zero investments, kind of 9 principles that should inform. So there's some real good momentum here. And as a way to kind of kick off today's panel discussions, we have actually a pre-recorded interview from a video from Jahi Wise, who is the kind of person running, as most of you know, the Greenhouse Gas Reduction Fund for the EPA. He would have been here in person, but he had a good excuse. His wife had a baby, so he is on paternity leave, but he was very keen to contribute to this discussion. So we're going to get a chance to hear from him, and then we're going to launch into the panels. But a warm welcome to all of you to what I know is going to be a very stimulating conversation. Thank you for joining me. So,
hello, I'm so glad to be here virtually with all of you for this incredible event hosted by the Green Bank Network. Thanks to NRDC for your leadership over the years in promoting an equitable and just green transition. Also, a big digital hello to all the leaders across the green banking movement who I know are participating in this incredible event, both in person and virtually. My name is Jahi Wise, and I have the honor of leading the implementation of the $27 billion Greenhouse Gas Reduction Fund. Over the last 15 years in my career, I've held several roles at the intersection of project finance, climate policy, and technology deployment, including in my most recent role as Special Assistant to the President for Climate Policy and Finance in the White House Climate Policy Office. The moment we are in is big. Let me try to put it in perspective. The President's Inflation Reduction Act, a key component of his Investing in America agenda, represents the most significant climate legislation in our country's history. The EPA's Greenhouse Gas Reduction Fund, which was created by the Inflation Reduction Act, represents the largest non-tax climate investment in this landmark law. The Biden administration is delivering on a once-in-a-generation investment in the future of our country, our economy, and each of our families. I commend the initiative that many of you have taken across sectors over many years to bring this Greenhouse Gas Reduction Fund program into being and to kickstart the clean energy economy in ways that even 5 years ago we might not have imagined were possible. I'd like to spend my time providing you all with a bit of a view into the implementation of the Greenhouse Gas Reduction Fund. But first, let me step back and talk a bit about how this program fits into the bigger picture. President Biden has been clear since day one of this administration that climate change represents both an existential threat and a massive opportunity to invest in our country. With that principle in mind, we have worked to use every tool possible to address the impacts of climate change while delivering real benefits to communities across America, particularly those who've been left behind. President Biden is committed to a whole-of-government effort to tackle the climate crisis, an effort epitomized by the 25-member National Climate Task Force made up of leaders from across the federal government, the nerve center of U.S. climate policy. To meet this moment, President Biden has set ambitious sectoral decarbonization goals that send the signals necessary for market transformation, including reducing U.S. greenhouse gas emissions 50 to 52% below 2005 levels in 2030, reaching 100% carbon pollution-free electricity system by 2035, and achieving a net zero emissions economy by 2050, all while delivering 40% of the benefits from federal investments in climate and clean energy to disadvantaged communities. And this administration has delivered an ambitious investment agenda to achieve these targets, including the bipartisan infrastructure law, CHIPS, and the Inflation Reduction Act. Thanks to the leadership of Administrator Regan, the EPA has taken on a significant implementation role alongside other agencies to protect the health, safety, and security of all Americans, all while transforming markets to lower costs for families and create economic opportunity, especially in those communities most often left behind. The Greenhouse Gas Reduction Fund, a first of its kind, $27 billion investment in a national clean technology financing network, represents a central piece of that catalytic climate investment agenda. The GTRF is designed to mobilize financing and private capital to address the climate crisis, ensure our country's economic competitiveness, and promote energy independence while delivering lower energy costs to communities that have historically been left behind. If my team does its job well, then this program will enable the institutions that you all lead to help more Americans to put solar on their roofs, more commercial building owners to lower their operating costs through efficiency investments, and more communities to build out the EV charging infrastructure to support the transportation modes of the future. As many of you know, over the course of this summer, EPA released notices of funding opportunities for the 3 competitions that are designed to deliver on the promise and the policy intent of the Greenhouse Gas Reduction Fund. The $14 billion National Clean Investment Fund competition, the $6 billion Clean Communities Investment Accelerator competition, and the $7 billion Solar for All competition. The $14 billion National Clean Investment Fund competition will provide grants to 2 to 3 national nonprofit clean financing institutions capable of partnering with the private sector to provide accessible, affordable financing for tens of thousands of clean technology projects across the countries. These national nonprofit financing entities will enable families, small businesses, communities, and many others to access the capital they need to install cost-saving and air pollution-reducing clean technology projects, with at least 40% of the capital flowing into low-income and disadvantaged communities. These national nonprofit financing entities will mobilize significant amounts of additional private capital with a goal of ensuring that every dollar of public funds generates several times more in private investment. These national nonprofit financing entities will also offer financial products so that grant funds are preserved, recycled, and reinvested in clean technology projects, delivering clean technology investment in communities across the country for decades to come. In tandem, the $6 billion Clean Communities Investment Accelerator competition will provide grants to 2 to 7 hub nonprofits that will in turn deliver funding and technical assistance to build the clean financing capacity of local community lenders working in low-income and disadvantaged communities, so that underinvested communities have the capital they need to deploy clean technology projects. These hub nonprofits will enable hundreds of public, quasi-public, not-for-profit, and nonprofit community lenders, such as the institutions here today, to finance clean technology projects in low-income and disadvantaged communities, with 100% of the funds from this competition dedicated to funding in low-income and disadvantaged communities. These hub nonprofits will create and strengthen self-sustaining clean financing programs across hundreds of community lenders nationwide, while mobilizing private capital into some of the most underserved markets in the country. To magnify their impact, these hub nonprofits and the community lenders they support will focus this entirely on 3 project categories that are critical to achieving U.S. climate goals and to benefiting low-income and disadvantaged communities: distributed energy generation and storage, net zero emissions buildings, and zero emissions transportation. Finally, the $7 billion Solar for All competition that will provide up to 60 grants to states, tribal governments, municipalities, and nonprofits to expand the number of low-income and disadvantaged communities that are primed for investment in residential and community solar, enabling millions of families to access affordable, resilient, and clean solar energy. Residential solar and storage is especially important for low-income and disadvantaged communities who pay the largest share of their income on energy bills. According to data from the U.S. Department of Energy, the national average energy burden, the share of income a household spends on their energy bills, is nearly 9% for low-income households, 3 times higher than energy burden for non-low-income households. Clean energy is bringing down the cost of energy prices, and this grant program will make sure that low-income families benefit by using 100% of the $7 billion to deploy residential and serving rooftop and residential serving community solar in low-income and disadvantaged communities. These competitions collectively mean investment in places too long underinvested in. They mean real projects like installing electric vehicle charging stations in the parking lot of a small business, keeping the lights on during a storm with backup power from a community-wide microgrid, no longer having to use the oven to heat an apartment thanks to a deep building retrofit and electrified heating, or being able to, for the first time, to put solar panels on the roof of your family home. And while each competition will be administered separately, EPA expects these competitions will work in tandem to deliver tangible benefits, lower energy costs, good paying jobs, and improved public health outcomes for households, businesses, and communities across the country. Applications under each competition are due October 12th, and we look forward to seeing the innovative ways that communities across this country will use these funds to advance equitable, clean investment. Through the historic Inflation Reduction Act, EPA will improve the lives of millions of Americans by tackling our biggest climate challenges, creating good-paying jobs, lowering costs for families, and shoring up American energy security. From day one, this administration has been committed to building a healthier and brighter future for all. EPA is excited, we are ready, and we will do everything in our power to make that future a reality. From you all, I request two things. First, remain engaged with our program via the GGRF website, where you will find information on upcoming public events, and via our inbox at ggrf@epa.gov. And second, we need everyone's help in executing on the mission of this program. This means helping to use the institutions that you all lead to make sure this GGRF funding goes as far as it possibly can and creates a ripple effect in our economy in an inclusive and sustainable way. Collectively, these competitions will invest in America to achieve nothing short of changing the status quo, tackling the climate crisis, transforming markets, and empowering communities along the way. Thank you.
Great. Well, good afternoon, everybody. My name is Adam Kent, and I'm Senior Advisor in NRDC's Green Finance Center. And I have the distinct pleasure to moderate our first panel today. And the theme of the day right now is partnerships. And we are focusing on partnerships because if we are going to equitably reach our climate goals, we can't work in silos. And as Jahi just said, we need everybody's help. We cannot simply design financial products in an Excel spreadsheet without considering policy and regulatory environments, consumer preferences, community outreach and engagement, and expect uptake and ultimately market transformation. We cannot concentrate on building affordable housing, being ignorant of the impact of climate change on our communities. And ultimately, we cannot expect broad political support for aggressive climate action from communities across the globe if we do not see tangible improvements in their own lives. So today, for our first panel, we'll discuss the critical role relationships across stakeholders play in delivering a more equitable clean energy economy, as well as strategies to develop and leverage these partnerships. We'll be diving into a moderated discussion for the first half, and then we'll turn it over to the audience to probe a little bit deeper. And I am honored today to be joined by leaders of 4 different financial institutions, coming from somewhat different subsectors of our financial system to talk about this topic. Oswaldo Acosta is the CEO and president of City First Enterprises, where he leads the organization's activities in new investment categories, including clean energy, small business, and residential mortgage lending. Oswaldo serves on several boards, including Capital Impact Partners, Vermont Energy Investment Corporation, and the Coalition for Green Capital. David Davenport is the managing director of the New York Green Bank, where he leads New York Green Bank's disadvantaged community lending activities, including financing high-performance affordable housing and beneficial building electrification that serves historically marginalized New Yorkers. David has over 30 years experience in real estate, finance, and government. Kerry O'Neill is the CEO of Inclusive Prosperity Capital, where she leads IPC as it operates at the intersection of community development, clean energy finance, and climate impact. Kerry chairs EPA's Environmental Financial Advisory Board, which was tasked, among other things, to assist EPA in their design of the Greenhouse Gas Reduction Fund. And joining us virtually is Margaret Trilly, the CEO and Chief Investment Officer of Impact Assets, where she is responsible for executive leadership, strategic growth, and planning for all areas of impact assets, including investment strategy and management. And we are also lucky to have Margaret, who serves on NRDC's Board of Trustees. So to start our conversation today, I was hoping our panelists could just give a little bit of additional context about your own financial institution, just so we can kind of understand the unique differences among the folks that are up here today. So maybe Kerry, I'll start with you. So could you tell me a little bit about your financial position, your mission, what sectors do you focus on, your relative size, anything else that would help?
Great, thanks, Adam. You tell me know each other.
Yeah.
We're a not-for-profit clean energy investment platform. We spun out of the Connecticut Green Bank 5 years ago, really as infrastructure for green banking focused on underserved markets here in the US. And so we focus on smaller project sizes, harder to underwrite credits, and we either do direct investment or we take productized approaches to help other lenders get engaged in green lending. We focus on consumer single family. We focus on affordable multifamily housing. We focus on distributed solar, commercial solar, community solar. And that's probably a good smattering. We're small but mighty. When we spun out, it was right before COVID hit. So we were capitalizing in a really challenging time, and that's impacted our ability to scale and be at the kind of place we want to be at. But we've got great investors and including some folks here on the panel, like New York Green Bank, in our fund that allow us to have impact.
Great, thank you, Kerry. I'm just going to go down the line. So Margaret, you're actually next up. So we'll go to you.
Thank you. Thanks for having me virtually. And sorry for not being there, but I've got fingers tied to keyboard working on those GGRF apps. So Impact Assets is a nonprofit impact investing firm. We run a number of programs for our clients. We manage about $3.1 billion in mostly in private markets, investments, debt, equity, and all kinds of other creative structures. We do about 275 private investments a year, and about we support 14,000 grants per year. We have clients that are institutions, foundations, corporations, and family offices, as well as individuals who want to work with us to really use investing to change the world, in addition to grant making. Folks come to us for that investment advice, and mostly we are an investment advisor, but in some cases we do take custody of the assets. So we have a lot on balance sheet, and we also advise outside assets as well. And we invest with a center of gravity around climate solutions and equity. Those are the two main themes that our clients lead us to. We build bespoke portfolios based on what their needs are, but that's pretty much where, there was a Venn diagram, that's what would be in the center of everybody's. And so that has led us to do quite a bit of climate investing. We invest directly and through intermediaries like CDFIs and green banks. We've done some co-investments with Kerry and Connecticut Green Bank. So we're definitely in the space, but we've been working through intermediaries to do the same type of work that green banks do.
Great, thank you. Oswaldo?
Thank you, Adam. I am Oswaldo Acosta. I am the CEO of City First Enterprises. We are a community development financial institution based in the District of Columbia. We are operating in both DC and Maryland. The main activities we have in the business is we're a lender. That's our core business. We have also been a grant manager for the District of Columbia in the context of COVID. The main work that we have two blocks of in our lending portfolio. We have commercial lending, which is affordable housing, nonprofit, some small business, and other smaller segments of our loan portfolio. But we also have a consumer arm. We do a second trust mortgage product for low-income communities. Smaller but mighty. We are a little bit less than $100 million in the balance sheet, $40 million a year in volume. That gives you a sense of who we are. Most of the work we've done on energy and climate finance has been through our partnerships with both DC Green Bank and Montgomery County Green Bank, both relatively new, nascent organizations. The work we've done with them have been different models. We will talk more about it in a minute, but that has been the focus of our role in the space, make sure that we capitalize on the advantages that we have in the presence we have in the market and the capital and the mandates that these local green banks have. That's who we are. Thank you.
Right, we'll be coming back to you on a couple of partnership questions on that later. David.
Yes, good afternoon. I'm David Davenport from the New York Green Bank. The New York Green Bank is a partner subsidiary of NYSERDA, the New York State Energy Research and Development Authority, which is New York State's leading agency focused on energy policy as well as our focus on climate reduction. The Green Bank supports NYSERDA, whose mission is really geared and focused on the Climate Act, whose goal is to reduce carbon emissions in New York State by 70% over the next 50 years. The Green Bank was created in 2013 with $1 billion of ratepayer capital funded by the Public Service Commission from ratepayers, with the goal of investing in projects that support the state's energy and energy reduction goals. We're pleased to say that as of this year, we've taken that initial funding of $1 billion and through investing it and reinvesting gains and being able to sell some of our performing assets to ESG investors and others, we've been able to grow that to $2 billion lent. And yeah, I'm pleased to be here and talk about what we're talking about.
Great, thank you, David. So as you can tell, we do have a bunch of different subsectors kind of represented here, everything from like government investment fund and green bank to international impact investment platform to a local CDFI really concentrated in a certain region, and to a national nonprofit investment fund that kind of straddles the green bank and community development space. David, I'm actually going to come back to you, and I was hoping you could tell the audience a little bit about New York Green Bank's Community Decarbonization Fund, which launched earlier this year. Can you tell us a little bit about the focus of the fund and a couple of key things that went into the structuring of that fund to ensure capital was right-sized for the solution that you were looking to see?
Thanks for that question. We're really proud of the Community Decarbonization Fund, which we launched in April. Governor Hochul announced the launch of the $250 million Community Decarbonization Fund. In April. It's a wholesale lending pathway that will provide low-cost capital to community development financial institutions and specialty lenders and some other carved-out entities that we want to partner with for clean energy and building electrification projects and other scopes of work. The Community Decarbonization Fund will support New York's equitable advancement toward the Climate Leadership and Protection Act, goals of reducing greenhouse gas emissions, as I previously stated, but with the specific focus of delivering benefits in disadvantaged communities, which had been a challenge. When I joined the Green Bank, we were really an organization that had done a lot of focus on renewable energy and project finance and had not penetrated investments in assets in disadvantaged communities to the degree that we wanted to, and I was brought in to lead that focus. It was very clear that we needed to create partnerships with the organizations that are working with people who have assets that are located in low and moderate income, or what we will call disadvantaged communities, community development corporations. And the organizations that do that best and do that well have historically been community development financial institutions whose mission is to focus on that. And so, you know, how did we get to what we're doing and how did we size it? Very simple. We asked. We spent 3 months engaged in a stakeholder outreach process, which included speaking with community development corporations, speaking with CDFIs and community lenders, some of whom are represented here in this room, as well as building owners and developers. What's it going to take to get the money into assets that are located in disadvantaged communities? How can we partner with you better? The response was very clear. We need long-term money. We need low-cost capital. We need flexible terms. So we listened, and we came up with a program that has financing terms that are longer than the bilateral lending that Green Bank typically does, one-to-one lending directly into projects which have fees and transaction costs, and typically start above $3 million. Okay, community organizations, community projects need, in many cases, smaller amounts of capital, and they need it on more flexible terms. So our desire was to say to this industry, how can we get money out the door? How can we best partner with you? And the response was through these terms, through this link, with greater flexibility, with low fees. And that was the genesis of the Community Decarbonization Fund. And I'm pleased that we've been able to launch and look forward to making it a success.
Awesome. Thank you, David. And Oswaldo, I'm going to come to you because we just heard how a green bank kind of looked to the CDFI and community development space to think about how they were going to partner. And you're coming from a CDFI space, partnering with a number of green banks locally. So, City First Enterprises has a long track record of partnering with green banks, both the DC Green Bank and the Montgomery County Green Bank. So can you tell us a little bit about how that relationship developed, how you approach those partnerships?
Yeah, thank you, Adam. That's a great question. And the answer continues evolving, of course. But I think when the local legislations were in place in the region, we knew that these entities, these green finance authorities, were going to be in the market with a clear mandate to finance a new asset class that we didn't have the risk appetite or the capital or the know-how to tackle. That was a natural marriage for us. We saw the opportunity to say, okay, you have this expertise, you have the political support and the megaphone of the municipalities and the local authorities to say, hey, let's go and evangelize about these projects. And we, on the other hand, as CDFIs, have a long history of trust and relationships and connections with developers, small business owners, and communities. So that was a national synergy, if I can use the term. So another element, another ingredient of that relationship, of that national relationship, was the fact that CDFIs, as you know, we have access to capital under favorable terms, but still we borrow. To give you a sense of our balance sheet, we have $50 million in our standing capital, but we have $30 million on debt. So we have, by nature, CEOs and boards conservative. And we have been working in this business of affordable housing, a small business, for the last 30 years, but we are conservative when it comes to a new asset class. And you had an emerging lending sector that was willing and was eager to take the risk, perceived for real, but it was a credit risk. So both partnerships with the Montgomery County and the DC Green Bank had different cadence, different templates. But at the end of the day, the formula was pretty simple. What do you have, and where we can help? How can we help you so you become an operational outlet as soon as possible? To give you an example, at the beginning of our relationship with DC Green Bank, they didn't have the lending infrastructure. Making loans is much more complicated than just giving you a check and then we collect the payment once a month. And so we had portfolio management staff, we had the portfolio management systems, And they, because they were nascent and they were eager to start, we partnered. Under a fee structure, there was a lot of trust in the relationship. That was the first element of the partnership.
First date.
The first date. But then, and Montgomery County was not too dissimilar to that, with different small details. But at the end of the day, the relationship evolved, and now it's more at the stage of a project. You know, you have a project that requires deeper capital that we don't have the ability to provide, and we go to a loan committee and say, hey, this is a $10 million transaction for which we can only do 40% LTV, but we have the partner that is willing and ready to go. So we get the yes for the loan committee. So it's both at the infrastructure level as well as at the project finance stage. And I think that is as these new nascent green banks across the country, they're evolving and maturing. The partnership will continue to evolve. I think this is by no means a static model, as we are already seeing in the local market. But I think, if anything, there are more opportunities to partner at the project level now. Kerry herself has been doing some great work with Montgomery County. One of the things we did, and I'm bragging now, is that we demonstrated that was a possibility. I think at the end of the day, we're lenders, we're competitive by nature. We need to demonstrate that there is room for collaboration, and the market is big enough so we all can have a piece in the capital stack. So that's what it comes down to. Something that we are not by nature good at the CDFI world, and I think the DC Green Bank, the novelty of the sector has certainly lubricated that collaboration.
That's
But it takes you out of a scarcity mindset, right?
It
Isn't that
does.
part of it?
Yeah, that's an excellent point. Nonprofits, we're a nonprofit loan fund. Nonprofits, at the end of the day, have access to the same amount of finite resources.
Yeah.
And there is a scarcity mentality. We grab whatever there is here and there, and we're always competing. Of course, we're now at the different juncture right now, because we have $27 billion. You do the math, whatever it is. So now we have to shift that paradigm and say, okay, there is much more liquidity than we can deploy.
Yeah.
And this is the time for us to collaborate. Easier said than done.
Yeah.
We haven't cracked the code as to how it works.
Well,
But-
you have.
Well, no, really, but it's, we need to continue working on. That's my point. And so I think that's where we are now.
That's great. That's great. And Kerry, if I can come to you to just talk a little bit about your work in Buffalo. As a Connecticut-based nonprofit lender coming into Buffalo, how have you kind of approached that context? How have you worked with the diverse stakeholders on your work there?
Well, there's a whole story as to how we got to Buffalo. It started with Ruth Ann Norton and Green and Healthy Homes Initiative inviting us in 2016 to a convening in Buffalo, co-led with NYSERDA, around, hey, we got a lot of challenges in Buffalo in the housing stock, and communities that need a lot of help. What are we going to do about this? And we got invited because in Connecticut, we were doing a big Green and Healthy Homes Initiative. And we saw an opportunity to bring some of the products and strategies that we were using in the multifamily and nonprofit sector in Connecticut. It's like, wow, Buffalo needs the exact same thing, but we hadn't spun out yet. It was like, oh, like, well, what do we do with that? We don't do anything with that. So fast forward, we spin out in 2018, and Lowenstein Foundation, Stuart Hudson, who many of us know, he had moved to Lowenstein, was starting up a new grant program, and he came to a number of us, and they had a program that was focused on small cities, second-tier cities. And we were very focused at that point with New York Green Bank and coming into New York State. Buffalo was the only New York city on the list. And so we kind of mobilized around, wow, this is our chance with Lowenstein funding to work with partners on the ground. We had gotten to know Push Buffalo. We got to know Western New York LISC. We used to work at LISC. We had contacts at the city and the county. And so we pulled together a consortium to say, this is an opportunity to bring some things that are working over here in the state right next door into your market. And that's how the work got started. But it was really hard. It was really, really hard. And in part, it was hard because cities, counties, groups like Push Buffalo, they already have a lot of challenges they're focused on. And now you're trying to get them aligned around clean energy and energy reduction and what have you. And yes, it's important. They want to do it and they want to learn. But it's hard to kind of get into that swim of resetting priorities, opening up resources, even when you're bringing resources in. So one of the things that we did was we had met a company called Dynamics that was able to, if you could give them a property list, they were able to do some virtual analysis of carbon reduction opportunities across a set of building stocks and a set of upgrades. And so we had city and county relationships. They had addresses. We were able to pull 800 addresses of nonprofits and affordable multifamily housing, run an analysis, tranche out into 5 groups what the opportunities were for carbon reduction, energy savings. And then that became the outreach list that we could give to our local partners on the ground with NYSERDA. Now 3 years has passed, and NYSERDA has a new program, the Clean Energy Hubs. I'm probably saying that wrong. And so instead of IPC in the lead, IPC is behind, and those local leaders are now working within the NYSERDA hub world, and we're supporting with the financing products, as it should be. So we're kind of leading from behind. But the work is long and it's hard, and communities have a lot of issues that they're dealing with, including the preservation of the housing stock, right? So.
And when did that work start? So just.
We got the grant from Lowenstein. So the work started in 2019 to pull the partnership together, and then we got the grant from Lowenstein in 2020, and it was a 2-year, but we extended it to 3-year work scope.
Long-term commitment.
Long-term commitment.
Yeah.
Long-term. And we're really now at the cusp of being able to do something.
Awesome. Thank you for that story. Margaret, can you hear us?
I can.
You good?
I'm good.
Okay, awesome.
I had to go get a
So I'm
charger.
gonna come to you. So Impact Assets recently formed a partnership with the Justice Climate Fund in a joint approach to the Greenhouse Gas Reduction Fund. I was hoping you could tell us a little bit about how you approached this partnership. What were some key principles that both you and the Justice Climate Fund needed to see out of each other to solidify this relationship, and any recommendations that you have for the audience that you think can be applicable to a larger audience?
Yes. Well, gosh, where do I start? I think it probably all starts with something I think there's probably many people in the room who could say the same thing, which is we base our strategies, and whether it's our corporate strategy or our investment strategies, on trying to fill gaps and to really be catalytic in more ways than just getting a deal done. We're always trying to see what other sweeteners we can do in terms of both our time and the dollars that we move. And so when we entered the analysis on the GGRF landscape to try to see what role impact assets might play, we were very much looking for gaps in the applicant pool, and ways that we could be extra catalytic. And we didn't necessarily, even though we're arguably large enough, we have a lot of the infrastructure, we do a lot of the volume, we do a lot of the deals, we work with intermediaries, we could check all the boxes to be a really credible lead applicant. We didn't go in with the assumption that that was the role we should play. And so right off the bat, we entered conversations with JCF with that natural curiosity, wanting to understand where they were, what their strategy was, where, how we might partner, what shapes that might take. And we were very comfortable being a sub-awardee or, doing, fitting in whatever way was needed. And right away, there was a lot of synergy and resonance in the impacts, the mission of impact assets and the mission of the Justice Climate Fund. And so I think we knew from very early on that we would be working together somehow, and the shape of that really evolved over time as we got to know each other, and it became really clear what the needs were for the Justice Climate Fund. Went so far as to having the board ask Impact Assets if we would consider the JCF becoming a subsidiary of Impact Assets in order to bolster its application status. The de novo, organizations won't score terribly well in the application process, and the Justice Climate Fund really didn't want to leave any points on the table. So we started discussing what that would look like. We really wanted to preserve both sides, but Impact Assets especially really wanted to preserve what the Justice Climate Fund stands for, which is communities in the lead. So it's similar to some of the comments that Kerry was making. It's so important that concept hold, that stay preserved and be honored and supported no matter what happens in this process. And so we began exploring what a subsidiary relationship could look like. It often, the more traditional way of doing that is that the parent has majority control of the board, and that's how an organization becomes a subsidiary. And that was a non-starter for both of us. We joked that sometimes it was Impact Assets and the Justice Climate Fund on one side of the table and the lawyers on the other side. We kept saying, can we be more creative? We don't need control. So how do we do a subsidiary if Impact Assets doesn't need control of the board? What does that look like? And the answer to that was a handful of board seats, but not certainly nowhere close to the majority, and operational integration, which was things we were talking about anyway. We were already talking about how can Impact Assets partner with the Justice Climate Fund to do all of the operational infrastructure, to rely on our ability to do 14,000 grants a year and 275 deals a year, so that those areas of the application could score well. And we also looked at the investment side and leveraging Impact Assets capital partners on the advisory side and integrating that way too. So we've through a combination of operational integration and some board representation, we've been able to bolster and really partner and come together in a way that I think is really, really fantastic. Impact Assets gets to do what we do every day, and the Justice Climate Fund and in particular the existing board stays in the lead, stays in leadership positions. The folks in the Justice Climate Fund subsidiary will be focused on leadership, strategy, EPA relations, programming, all of the fun stuff. And Impact Assets will be supporting anytime there's a decision to be made. We're supporting the decision, not making the decision. And I think that's a super important design principle that we've held through from the board level all the way down to how deals get done. Really, because we do want this to be what it's set out to be, which is the application led by LIDAC communities. So that's the story of how we got to here. And I think the thing that makes it translatable to other situations is maybe just the willingness to be that creative and not to assume that just because you can, you should lead. I think we've found certainly this is the most catalytic way that Impact Assets can be, and we are thrilled about that. We don't have to be in the lead to feel like it's the best outcome. In fact, this is the best outcome. We're able to bring all of our things to bear in a way that makes something better than what we could have done by ourselves.
Awesome. Thank you, Mark. That's a great lesson to share. And if we could stay on the Greenhouse Gas Reduction Fund theme a little bit, maybe just go down the line. David, I mean, New York Green Bank, largest green bank in the country. How, as you reflect on the opportunity that the Greenhouse Gas Reduction Fund presents for the United States, how is New York Green Bank thinking about this and your partnerships? And others on the panel, please feel free to jump in and kind of how you are all thinking about this kind of once in a lifetime opportunity, or at least historic opportunity that presents.
Yeah, well, it straight up feels like a once in a lifetime opportunity right now. We didn't expect it, couldn't see it coming not too long ago. And we are part of an ecosystem that is working collaboratively to figure out how to use the money as efficiently as possible. Since the act was passed in August of 22, we've been busy evaluating opportunities, especially the $27 billion greenhouse gas reduction fund. We've also regularly been engaging with others in the ecosystem, other green banks, CDFIs, industry groups that support specialty lenders and FinCos to evaluate possible approaches to apply for the money. NYSERDA, including the New York Green Bank, intends to be part of an application for all three competitions under the GGRF, the $14 billion National Clean Investment Fund, the $6 billion Clean Investment Accelerator, and the $7 billion Solar for All. The amount and structure of our applications will be determined by final competition and structure guidance, but it is certainly something that we're all rolling up our sleeve and working on collaboratively and efficiently and readily.
Yeah, yeah, please, that's one.
I ditto to your optimism. I think we have once in a lifetime opportunity to get to have a transformational impact on the work we do in the work we do in clean energy. However, I think there is also a big risk that we get it wrong. That's a possibility that we fail to catalyze or to create a new market. That's a possibility to. At the end of the day, we're talking about the industrial policy or transformational industrial point, the most ambitious, as you said, in perhaps the last 60, 70 years. That's a possibility. That is one risk. The other risk that it's very latent, and we're now in an application mode. Of course, we have to go on the rosy side. But the other risk in this room we can share is that we fail in actualizing or materializing the Justice 40 goals or the progressive side of the agenda, because at the end of the day, this policy was created in the political context, in the political momentum. It didn't happen in a vacuum. It wasn't just a technical decision. We're going to create a new market because this is technology ready. It's part of the political momentum, as I said, and we're working. This very conversation is part of it. We're working in trying to articulate a way we can get the capital to those low-income communities, to small businesses, to disadvantaged neighborhoods in Appalachia and DC, in Baltimore, and Pittsburgh. And it isn't clear yet. I mean, it's very hard. These projects require subsidy, a lot of technical assistance, a great deal of, we use the term customer acquisition, but that's an euphemism for saying just go and talk to the landlords and make sure they are willing to deal with the split incentive issues that we will face. I don't know if we are ready yet. I remain optimistic that by the summer of 2024 or the fall of 24, we will have a more clear view as to how do we do that $1 million deal that requires $250,000 on very patient capital that doesn't look like debt, and it still continues to adhere to the NCIF programmatic features. And who is going to be part of that? The $6 billion on the NCIA, perhaps. So we are still on the contours of how it will work. But I think just to be on the pessimistic side, just to make to have a conversation, and the contrarian side, I think there is also a risk that we don't get it right. And I think we will do a disservice to the discussion, to the debate, if we don't tackle that now. That's
so picking up on that theme as well, though, because I share that concern. We spend a lot of our time talking to CDFI credit unions, talking to CDFIs, talking to green banks about how do you serve underserved communities, and it takes a lot more than financing. Financing is almost like the least of the issues, right? It's all the other supports that are needed, the education, the outreach, the subsidy, the engineering expertise, what do I do? Who do I trust? All of that. And so we're paying in this moment special attention to applicants that have strategies that are well-funded, well-founded, using best practices that we know will support deployment in low-income communities, and questioning those that don't, and really aligning ourselves around that, because that story I told in Buffalo, no financing yet, right? I mean, that's all technical assistance, years of laying the groundwork to get ready to finally finance. And so that's where we're thinking about in these applications. And we do see a continuum from Solar for All to CCIA to NCIF. You can like feel it and see it, and it has to be pulled together. And that is the opportunity to take your contrarian view and put it positives, but you better get it right.
No, that is
Otherwise,
absolutely
we're
right.
not gonna be sitting in Congress.
I think it's a matter of, my concern is just to continue on that contrarian view. I'm a capitalist. I'm an economist by training. I believe in the power of markets. But at the end of the day, the gospel of debt, the gospel of finance has dominated the conversation. Because it's, at the end of the day, we have a democracy, and we have one side that thinks that this is okay, industrial policy works. The other side says, no, we don't want subsidies, blah, blah, blah. And that's at the full lines of American politics. But at the end of the day, the fact is that these projects will need subsidy.
Yeah.
How do we match $14 billion or $1 trillion of debt, of finance, whatever Goldman numbers gave, wrote a few months ago? How do we match that with a piece that is not, that the economics of that project doesn't work? I mean, maybe technology will rapidly change in the next 3-5 years, and all of this will work. But just getting $1 million project ready to go is about $150,000 if you include all the projects that didn't work out. So how do we solve for that puzzle? That's a complicated one.
Yeah, and that's great. And I mean, and I think the long runway is kind of what explains that long runway is a lot of historical decisions that have left many communities in the US and globally in a place where there is crumbling infrastructure, where there are a lot of historical wrongs that need to be righted. And so practicing differently, thinking about partnerships differently is really critical. Kerry, if I could come to you, and this might be our last question, so other panelists, please jump in. But for IPC, your organization, it was really kind of spun out of Connecticut Green Bank, created to really foster partnerships across the country, focused on addressing climate change, focused on demand generation. What were some key organizational decisions, whether it was kind of in the weeds bylaws or board of directors, that you kind of made that has now kind of facilitated your ability to engage in partnerships quickly? And others on the panel, please jump in about some others as well.
So I think it was what, Margaret talked about this, and I said too, we ultimately, like leading from behind. So we saw ourselves as infrastructure, and to accomplish our goals, we didn't have to be always the direct investor. We could be a co-investor. We could teach other lenders how to do the lending and bring productized tech-enabled platforms, right? And so I think it was a perspective about what's the plumbing and infrastructure that are needed for community-based lenders and green banks around the country to focus on underserved markets. And then a really, really healthy respect for the technical assistance required to make these deals happen. And so that informed, like instead of us hiring a sales force to work nationally, no, we're going to work through communities on the ground, through community lender partners or other community partners. And that's hard, and it's expensive, and it's slow, but it's also kind of what Margaret was talking about, the values of the Justice Climate Fund. Like, those are the values that are going to have the deepest impact and right the wrongs on the ground. So it wasn't necessarily written into the bylaws, but certainly in our pro forma models and our fundraising and capitalization models, like an appreciation and understanding, it is more expensive and it will take more time. and it needs ultimate scale.
Anybody else?
I would quickly add that I really like what a lot of the things that Margaret said, but one thing that resonated with me was that we are trying to find the gap. And everyone is thinking about affordable housing, EV infrastructure, some maybe larger community solar or utility scale, blah, blah, blah. But I think we as community lenders in the region, we need to find the niche, the gap that is underserved. I can share with you that I'm obsessing about supply chain. How do we become part of the lender of first resort to all of those new contractors in operations and construction and vendors that will be doing work for wind solar in the Eastern Shore of Maryland? Who is going to be, what are the entities that will be lending to that $5 million company, lines of credit? The CDFI world, my colleagues will kill me for this, but we're not ready. We don't have the penetration. We don't have the ability to serve all of those nationally. How do we create the liquidity for all of these small contractors in Ohio, from Ohio to Los Angeles, to say, if you have a $500,000 contract, you have historically not been able to do that, but you will now. How do we make sure that you apply through our portal?
Right.
And in a matter of, we don't have to reinvent the wheel. I'm gonna go lend the club now. In a matter of 24 hours, you can apply and you get the money. How do we do that? Yes, right? And that's a niche, to echo Margaret. What are the niches? Because one of the things
Those friction points, right?
the friction points to eliminate, create a market, and I think that is going to be the challenge. How do we don't overcrowd the space and leave other markets that are more important underserved? And then once the market comes and for-profit companies are able to fill the gap, then we move on. We do something else.
So maybe this is where this conversation needs to go. You're a capitalist, we're capitalists, but capitalism, equity is not at the top of the list of what it seeks. It seeks return, right? We know this stuff works. We know electrification works. We know renewable energy works. We know storage. We're working to make it. But we know these investments work, but they have a long return period. And the highest return for a dollar invested in communities or buildings doesn't come from energy efficiency. You will get a return, but it's a longer return. So this is where we need government. This is where we need policy. This is where we need, more stick. But specifically, catalyzing an equitable green solution. What I'd like to hear in this room is, well, let's talk about what does that look like? What's in disadvantaged areas, and what assets can be transformed equitably? What does that mean in terms of ownership, in terms of who does the work, in terms of how that work is financed, which we address a little bit here. But one thing that I think everyone can raise, and I hear it, everyone can raise the question, where's the money going, and how is it funding equity? Well, let's talk about what does that look like, in a way that attracts investment.
Yeah. And this actually, we're transitioning to questions from the audience, even though I have a lot more for you all. But this actually is a perfect transition to talk about what does that workforce look like. So we have a question from Zoom. To achieve our climate and clean energy goals, we need a workforce for decades to come. There has been federal funding through the infrastructure bill for short-term workforce development, but funding is needed in the K through 12 clean energy education. are any of your organizations investing in education of the next generation who will lead and implement these efforts? And if not, and I'll add on this, if not, do you see opportunities potentially in the GGRF to do that?
We're not.
No, we're not. And I don't know, can you in the GGRF? Those of us who are studying that, I don't know if you actually could, but I think you could foster partnerships with schools, right? Where you're citing, heat pumps in the school and you're citing solar in the school, and then you're through Department of Education resources, developing the curriculum that's teaching kids about, I think it would be like an all hands on deck, how do we leverage the schools and kids to develop that curriculum.
Right. We have a lot of folks in the room. So any questions for our panelists?
Ilmi Granoff, Columbia Law School, other hats. The stuff that's decarbonized quickly and gotten deployed, it tends to be manufactured. A lot of what's been relatively easy to finance, solar PV, onshore wind, has benefited from a lot of the engineering being able to be produced in a factory and then delivered on site. And when I think about the kind of transactions you're talking about, they seem really bespoke. And both the financing is not standardized, but also the implementation when you're doing a deep retrofit, it's not, the boiler, a heat pump may be manufactured, but the installation requires a lot of on-site work. Do you see opportunities? So everything from the financing to the actual engineering, do you see opportunities within the technology space where you're like, this could start to be standardized from the engineering through the finance in this space? Yeah. What's the subset that has the most promise?
Margaret's raised, yes, I think it goes to building types and technology types and what works. So heat pumps, may not work in every single building type, but they will work in certain building types, certain types of single family homes, certain types of commercial and multifamily buildings. So you need to lift those up and then kind of let's go find a lot more that look like that. What are the channels to do that? Through community-based lenders or through contractors or, education and outreach, and then standardize the lending for that profile, very broad credit box, and aggregate it and pull it through to secondary market liquidity solutions. So it's like taking it off one by one by one profile, building type, technology type. I mean, when you get to whole building retrofit, that is a different kettle of fish. And I don't know. Maybe other people know.
No, I agree. That is going to be the defining factor whether or not we can scale this. That's an excellent point. I think the example you gave about dynamics, customer acquisition. How do you standardize?
All that is reducing soft costs.
It's reducing soft costs, and it's making sure that you have a pipeline of 150 deals as opposed to 5 that are pretty gimmicky and unorthodox in all possible ways. That is the hardest part. You spend hundreds of thousands of dollars in getting to a deal that it's just, the math doesn't work. That technology, I think the market will get more mature. No, I don't think will be commoditized the way that big solar did, what big solar did, or other sectors of the climate engineering work. But I think it could be more standardized for sure. And then moving to the other end, just to bring liquidity to those assets and just recycle the money. But that's a different question. The question is about the engineering. It's very hard. And the same for a small business. I think the most promising aspect of the most promising segment is perhaps community solar. That technology is there. We need to do more evangelization with the communities, make sure that they adopt the technology. We bring some subsidies. That is a little bit more scalable at the rapid sense. That is the low-hanging fruit.
I think also certification of contractors is under leverage. Certified contractors doing quality work that's been vetted on the back end, and then maybe you put an insurance wrap around it for a production guarantee, right? So I do think we have the ideas. We just have to put them in place in a systemic systems change way.
Margaret, if you want, please jump in.
Thanks. Some of the other things we're seeing, because while we do invest in projects like these through intermediaries, we also invest directly in companies that are trying to tackle some of these problems. And we've seen AI be a really interesting introduction with sensors and heat pumps and fans, trying to look at that, tune that very unique building envelope to really optimize energy use across all of those different factors at once. And we've invested in a number of companies that are tackling that at the commercial and industrial scale, warehouses and whatnot, but even, downtown high-rise buildings. And it's, I mean, we've all been in that building where the sunny side, the people are sweating, and the other side, like everybody's freezing, and they have heaters under their desks. Like, so it's solving those problems through AI is something we're seeing, have a lot of promise, but you still have the problem of, motivating the market. Which back to David's early points, the payback is over a long period of time. And so we're starting to see some interesting financing models where the companies that are doing this work with AI are compensated based on a percentage of savings, as opposed to total cash outlay. Some really innovative models coming out there, a little bit orthogonal to the conversation we've had today, but some good breakthroughs, I think.
Yes.
My name is Jahi Logan, and I am co-founder of a startup called Raise Green, and we are a crowdfunding portal that focuses purely on climate solutions. And this is not a recommendation, but one of the companies that has raised capital on our platform is National Energy Improvement Fund, and they're startup themselves and
B Corp
and what they are doing is addressing exactly that. And their model is basically they are training contractors, to your point, in energy efficiency, how to sell it, et cetera, and et cetera. They become then certified contractors and have the benefit of all the expertise and wisdom of the folks there. And then the National Energy Improvement Fund works with entities that are looking to finance these kinds of projects, but not necessarily be the front person. And so this organization is trying to exactly tackle that. And so there is a model out there that is working on.
We are partnered with Knife on bridge financing for contractors, so love them. Great organization.
Any other questions from the room? Yes.
I'd love for you guys to talk about the financial tools and structures that are working for you guys and the ones that you're optimistic about. Like, say, what is the role of catalytic capital in helping you guys scale up this work that you're doing? Sure.
Thank you.
Go first.
Go first. I'll go second.
The question is, what is the work we're doing to catalyze the investment in communities solar? Is that a fair characterization of what are the financial structures we're using to make that happen?
Yeah, you touched on it very briefly when you spoke about the partner patient capital. So maybe build that up more in terms of how you're using.
I got it. All right.
Yeah.
You go.
So we have a model that Connecticut, Colorado, Michigan, California have used, where you take some credit enhancement dollars, public or foundation credit enhancement dollars, to get local lenders like credit unions and CDFIs to offer a standardized unsecured loan product to all kinds of customers, but also to low income and credit challenge customers. And you do it through a vetted contractor network. So it solves a couple of things. It's solving an access issue. So you're offering a well-priced, below market interest rate to that customer. You're doing it through a lender who's in their community, so they understand the challenges of those borrowers. And maybe if the credit score isn't where it needs to be, they work with the borrower over time to get it where it needs to be. And you're making sure good quality work is happening because you've got good quality contractors. So that's one example. And one could imagine taking that a step further and not even using a credit score, but making an alternative underwrite. So there are some really interesting consumer originators who are using utility bill history or alternative ways of evaluating credit that starts to right the wrongs of a credit scoring FICO-based system for communities of color in particular that have been really damaged by that sort of scheme.
Yeah, but there's a failure in finance. We're asking for low-income consumers to pay for something that through a debt product or other structures, which is just not, it's not tangible long-term with 50% of the population within the LMI communities and things. So
I
and
think
we're not pricing issues that have caused these issues, these problems. So
No, I think you raise a really great point, John. I don't think this is going to work for deeply low income people, but there are folks that are, upper, you start to segment the market and you figure out who can be addressed with these sorts of strategies and you keep working away at it.
With it, can I just make a quick point?
And then Margaret. Yeah.
Oh, I'm sorry, Margaret. You want to go first?
Go for it.
I wanted to make a quick point that we haven't discussed today in that spectrum of equity. I think Jigar Shaw wrote a book about this maybe 10, 15 years ago, and it always stuck in my mind, which is about the wealth creation opportunities of clean energy, the clean energy transition. And what is going to happen with this $27 billion infusion into the economy is that a lot of people will create wealth. Who are going to be those corporations and those businesses, those individuals? Is it going to resemble those who already have a large piece of the pie, or is it going to be people like Luke Lamy or you, or people in places that they haven't been part of the green solar or the big solar movement? Corporations in this country have benefited from the ITC and a plethora of instruments. They've created wealth, which is great. We're at a different point now, but not only the servicing, the delivery of kilowatts hour, is just also the opportunities to create wealth and kind of level the field a little bit in terms of economic opportunities. It's not the intention of the legislation. It's not a core tenet of this policy, but I think it has to be recognized that these contractors, these businesses, these startups need to look like modern America. That's just a side point, but I think it's related to yours.
And we're closing in on time, so I'm just going to ask the panel one last question. But this really is an opportunity to practice differently. And about practicing differently, it also means about working with partners that you may not have worked with in the past, and to have the patience to really take the time to build those relationships. Final question before we hand it on over to panel two for our group is, what's one word, phrase, or theme that that was highlighted today that you want to make sure our audience leaves with? And maybe I'll start with Margaret on our screen.
Oh, I have to do a phrase. I can't pick just one word. I would say either communities in the lead or lead from behind. I think those are our big themes.
I was going to say lead from behind too. Partner deeply.
Okay. Holding lead from behind.
It has to be very tacky or maybe cheesy, but I would say a new way of doing public finance.
You said one word?
One word or phrase.
Another phrase.
Phrase. Yeah.
Opportunity. We're on the verge. Assuming this country embraces the reality of climate change, we're on the verge of a new economy. There's a lot of technology that needs to be developed, a lot of partnerships that need to be created. But if and as we transition from fossil fuel there's tremendous opportunity, the likes of which we haven't seen in a generation. So the focus needs to continue to be on equity as that takes place.
Thank you, Dave. Right, and thank you for our first panel today. And
Thank you, Alan.
second panel, please come on.
We want to get into, I think I have the easiest job of the entire day. I have 4 amazingly smart and amazingly impactful people, and my job is just to help them tell their story, which is really quite easy because they have amazing stories to tell. So my name is Sarah Doherty. I'm the director of the Green Finance Center at NRDC, and we are the secretariat for the Green Bank Network that Caroline was talking about. And today we're going to take it from this different version of using these tools into the actual institutions that are doing some of the work in a more specific way, green banks or development bank, in this case, that is using a lot of these tools. And we're going to really talk about how this model was created to solve problems that private finance is not able or wanting to solve. Let's talk a little bit about some of the conversation from the earlier panel. One major issue is making sure everyone benefits from the clean energy economy. So how do we do that? It used to be hard to finance lots of things, like maybe even large solar a long, long time ago. Now that's not the case. But now it's not going to all of the smaller, distributed, and lots of different communities don't have access. So reaching all parts is still not easy. Green banks are generally flexible in order to help solve local issues instead of give everyone a hammer, because not every problem's a nail. So really giving that local context. So today we're going to hear from 4 different perspectives on how to do that. I also want to highlight that this is something that is a proven model that needs local level in both the global north and the global south. That this is not just a developed nation issue or model, that this is something that the Green Bank model is really well positioned to do. And we need monies. We need monies. That's true. We do need monies, but we need ways to get money to the communities that need it the most. So that's going to be one of the things we're really talking about a lot today with this amazing panel. And we're going to start off with each of them introducing themselves more completely and their organization. But I think we can start maybe from the far side, if that makes sense, with Tricia Miller, the CEO of the DC Green Bank.
Great, thank you. This is the largest roundtable I've ever seen. I feel like you guys need to come closer, but it's okay. We'll project, and we've got our colleagues on the screen. So Tricia Miller, CEO of the DC Green Bank as of July 31st. So I'm new in this role, but not new to climate finance. I came from the White House where I was the senior director for building an industrial decarbonization in the climate policy office of the Biden-Harris administration. So I've seen a lot of the policy work go from design to implementation, and would just emphasize that in the last panel's discussion, I think there's this important and inherent tension of creating a long runway, right? Like we want to build the models that are durable, that are successful, that are centered in equity. We also need to deliver with an urgency and a pace, speed that we've never seen before. So I think for all of us, it's really how do you live in a world with those inherent tensions and build something that is successful, scalable, and supports our climate investments to reach underserved communities. And that's been the challenge and the opportunity that I think the Inflation Reduction Act presents. And in our role at the DC Green Bank, I'll share more on our models. You don't want us to do our...
Oh yeah, please.
Go ahead. Okay. So I'll give you an example of kind of how we were created. The DC Green Bank started under statute in 2018 by the leadership of Mayor Bowser in DC City Council. We are all about partnerships and centered our work out of the gate, as Oswaldo mentioned, with City First Enterprises and a number of community lenders and partners and community-based organizations. Our full operation started at the height of the pandemic. So like many of you, we overcame very trying times and are now positioned to grow and take a major leap forward together. Our mission is to deploy public dollars, crowd in private investment, and ensure that communities, businesses, and our workforce all benefit from climate solutions for generations to come. And at the DC Green Bank, we're laser focused on three key parts of our mission. One is to deliver on inclusive prosperity. So the conversation around equity really resonates with us because that's what we were stood up to do, to support a clean energy economy and advance sustainability. And that means that green finance should benefit everyone and contribute to that clean energy economy. I'm going to share one quick case study on our work in the solar space, and just wanted to start with framing it at this is Climate Week, and I was looking at some of the global numbers from WEF on women in the renewable energy sector. We're still only at just under 30%. So it's about gender equity. It's about leading with communities of color and underserved communities. And a couple examples of how we've really started to unpack that and support DC business opportunities for emerging female leaders in underserved communities. One example is Flywheel Development. It was one of our first loans at the time of the pandemic. Many private institutions were pulling back. DC Green Bank set up a series of community solar financing opportunities through an emerging woman-owned solar developer named Jessica Pitts, who leads Flywheel Development. So with about $2 million in a construction loan, she was able to support the delivery of 7 solar installations across the community. And we were able to reduce energy burdens for over a dozen low and moderate income district families. So this was one of the examples of how we could kickstart the work with a local partner, but also grow and support Flywheel's development hub, which is now bringing together 10 different women, veteran-owned and communities of color businesses, creating over 35 construction jobs and over 20 permanent jobs. That's just in the last couple of years, but that gives you a sense of the kind of model that we're trying to build, not in a bespoke way, but also anchored in community leadership and supporting partnerships with district residents. So I think I'll stop there.
Wonderful. Like I said, so much interesting work happening. So we'll go next to Bert Hunter, Executive Vice President and Chief Investment Officer of the Connecticut Green Bank.
Thanks, Sarah. Good to see you again, and good to be with all of you here. And Jason, you there?
Indeed. Are you able to hear me all right?
Yeah, you're coming through loud and clear.
Great.
So yes, Connecticut's Green Bank, we're the first, I will qualify this by saying full-scale Green Bank in the United States, state-level Green Bank in the United States. I say that because there are some others that will say, well, we were first, we set up ours. But we were the first to do everything across the board, meaning all the sectors, residential, commercial, industrial, not-for-profits, and then state and muni. We touch every sector, and we do it through a variety of tools and mechanisms, everything from loans, power purchase agreements, and other mechanisms that we put to play in the marketplace. We work with private capital. Over our history, we've deployed or been behind about $2.4 billion worth of investment in the state of Connecticut, using about $350 million of public funds. We were fortunate when we were, through our enabling legislation, we inherited from what was called the Clean Energy Fund about $70 million of cold hard cash. And what's good about that is when you show up with $70 million in any room, maybe not this room, but people will listen. You got to show up with $1 billion in this room. Let me tell you, it's $1 billion table. But for other rooms, showing up with $70 million gets attention. Plus, we're supported by a system benefit charge, which brings in about $25 million a year. The greenhouse gas, Regional Greenhouse Gas Initiative provides another $5 million for us, about 25 million to the state of Connecticut. And that goes all the way from Maine down to Virginia now, although I think Virginia's has some issues with their governor, maybe trying to push back on that. We also, because we've now been in operation for 10 years, 11 years. We have a portfolio. Our balance sheet has grown from the $70 million of cash, where it was pretty much all cash to $250 million, and about 80% of that is investments. So we're spinning off free cash flow of about $10 million a year. And plus we have, when we have done incentives and transactions, we own the renewable energy credits. So we have another $8 or $10 million a year that's coming in from that. So top line revenue is about $50 million a year, which we plow back into the marketplace with a variety of transactions. I think that's the way you should do a green bank. You should capitalize it properly. You should provide it with enough revenue on an annual basis through various mechanisms, and then that allows you to innovate and be flexible and reimagine climate finance, which is what we've done from day one. We were given a number of responsibilities to undertake in our enabling legislation, because we were brought through a statutory process. Connecticut, just by reference, we've been doing climate policy for probably a quarter of a century, going back to 1999, 2000, that neck of the woods. And so we kind of came midstream of that. So with the Clean Energy Fund that was established in the 2000 era, and so we came in 2011 and started doing that. Well, when we were brought through, we were supposed to be doing a few things. Residential solar was a big emphasis. We were supposed to do 30 megawatts in 5 years or 8 years, something like that. We did that in 2 years. So what they do, they said, okay, now do 300 million, 300 megawatts. And we ended up doing 380. So we had to, but by given those imperatives, we had to say, what's going to make this market work? Because the contractors didn't have financing mechanisms. It was basically a market that was driven by people who had the means to use their home equity lines or write a check to get solar. So we wanted to democratize that. So we worked to develop solar loans. We set up a solar fund to do solar leases. And then we also set up this Smart E loan, which was referenced by Kerry O'Neill. And now they're taking Smart E and taking that nationwide. Those tools basically now leveled the playing field for people to be able to participate, because it made capital accessible. And what it also did was it allowed contractors to compete with national firms. So for example, when we set up our solar fund, we said, we looked at the market, we said, look, we have to be just as good as Solar City. Solar City really wasn't in Connecticut. We said, we have to be as good as Solar City. So what we did was we brought in an insurance product to make sure that if a Chinese manufacturer went out of business, that loss would be covered. Because when we presented the transaction to the board, we said, that is a risk the green bank should not take. Let's lay off that risk. So we actually developed with an insurance company a product to cover that risk. So it was through the innovations like that we were able to get multiple contractors, gave them the power to price their product, bring down the cost of solar, and democratize access to market. So we're working on several levels, but the policy framing is essential, meaning that the money that we were given would not have allowed us to do what we were doing unless we had the policy framework that allowed us to use carrots to deal with the sticks. You have to have both. So it was through the process that we undertook over very quickly in a few years, was to put enough carrots into the market to encourage the market to compete, bring capital in, and get to work. And that's what I think we did. So I'll stop there and transition now.
Well, great. So next we'll go to Jason Patrick, Chief Investment Officer of the New Zealand Green Investment Finance Corporation.
Yes, and indeed, in case there's any doubt, we're New Zealand's green bank. I can, if you like, make a few introductory comments about the Green Bank itself, and then there are definitely a few things to say in this particular market on what we call just transition here regarding equity in the way we do our work. So most importantly, I think to provide a little bit of context for the Green Bank here in New Zealand, I always tell the story about how this institution was set up, in which the policy personnel who did so, I thought did a really good job, and which is why, in fact, I was tempted to come over here and work with the bank. Namely, they went around and visited some of the existing green banks, including speaking to Bert and some folks, I think, from the New York Green Bank as well, about how their institutions were set up, how they went about their business, what worked, what they wish they could do, what doesn't work so well, and took away, in my opinion, some really valuable lessons, which allow us to be successful today. For example, we were set up not as a political agency like some institutions are around the world that are green banks. We were set up as essentially a standalone independent corporation under the Public Finance Act here, which allows for two-way insulation from political processes here, which has been really valuable, in my opinion, for how we go about our business. Perhaps most important, we have a remarkably broad and flexible mandate. For example, as I'm sure folks in the room know, the original green banks actually were largely focused on a relatively narrow set of investment structures and sectors, most commonly, of course, debt for large renewable generation projects. By contrast, again, based on those conversations we had with some of our now peers, we set ourselves up with a virtually unlimited investment mandate. There are a few things that we can't do, but in general, we not only can do, but now have done all of corporate equity, project finance, senior debt, sub-debt, credit guarantees, and financial product development and management. That's been very helpful. And just as important for the impact of our organization, which is climate focused, we operate in every sector that is material from an emissions point of view in New Zealand. So today we have about $800 million assets under management, which because New Zealand's a considerably smaller place from the US, makes us by a mile the largest climate financier in New Zealand. So happy to talk about any aspect of our work. And then Sarah, if you'd like, I can speak to some of the equity issues now or later. What would you prefer?
It's great to do it now so we can go to questions after.
Sure, happy to do. It's a very different context in New Zealand than certainly in the US and a lot of other developed countries. By that, what I mean is that the integration of Maori into society and business in New Zealand is just way different from where I come from. And so I'm also from Bert's home state of Connecticut, and there's just no indigenous presence to speak of there, like in most of the US. It's utterly different in New Zealand. Just to give some examples, the iwi, the large Maori groups, are the largest, or at least by plurality, the largest owners of fisheries, of forest land, among the largest in agriculture. They're by far the largest landowners in New Zealand. And to this day, iwi land cannot be purchased. So the asset base for the iwis is staggering. And unlike in a lot of other jurisdictions, many of the iwis have and run some of the largest and most sophisticated corporate investment entities. So some of the iwis, such as Ngāi Tahu and Ngāti Whātua, are among the largest investors in the country. So we recently did, for example, a grid connection transaction of about $25 million out in the eastern side of the North Island with an entity called the Eastland Group, which owns not just some of the generation assets, but also a port and an airport in that region. And the beneficial owner of that entire group is the local Maori iwi. So it's an utterly different operating landscape. The second point I would add is that what's called just transition, i.e. the sharing of benefit and the incorporation of principles of inclusion in climate policy is fundamental to climate policy in New Zealand. And what my friends back in the US will always be amazed to hear is that climate policy is not a controversial issue in New Zealand. So there's no debate amongst the major political parties on the value of net zero by 2050. So it's a very different social operating environment here than it is in the US. And again, these principles of just transition, of inclusion, and principles of resilience for all communities are fundamental to the work that we do here. Oh, sorry, I can't hear you. Oh, there you go. Yeah.
It's hard to imagine what it would be like to have climate not be political. I think everyone in this room is kind of, that must be so nice. Should we all move to New Zealand? Maybe.
Yeah, just to give an example, there's an election going on here right now, and there was a debate between the two major parties here. It's a parliamentary system, but there are two large parties, much like Democrats and Republicans, and they were competing with each other to discuss, the ambition of their climate policies. It's very different.
Very different. Well, we're going to go to another different context outside of the United States. Aurea Carvalho is the project structuring manager from BDMG, a development bank in Brazil.
Yes, thank you all for having me today. I would like to start saying that my first takeaway from this panel is that maybe I rely too much on my memory because I have these two sheets and they have a huge tons of things noted. So let's see if my memory works. BDMG is a development bank in Minas Gerais state. We are a state in Brazil. We have 20 million people and we exist we have 61 years. We are a senior bank, but we've been transforming through the years as a mission. When we started, our mission is to help to industrialize the state. When the car industry went to our state, and now we are trying to be a bridge between the global agenda and what the cities and the companies and the small companies do. So we are trying to use funds, international funds, and some internal funds too on the Brazilian capital market to leverage the industry and to try to say to the companies and try to incentivize the companies to have this look to decarbonization, to better practices, to equity. And for this, I would like to bring an example. We have that it was interesting because we have this before we had the name. So we have BDMG Solidário. It's kind of a solidarity name. That is, each year we have some natural disaster, but we cannot say which city will have it. So imagine, it happens. We have this all day in the news, but we have it's not the global right now. We have the Libyan incident, so it's sad. But in our state, we had almost in January we have floods, lots of rains, and people losing his houses, and to not have to start over again, like we need to make a response. We had a product that we can use for this kind of population, and it's being used as a fast response because to not have to evaluate if a company is going through some issue related to that, we choose just for medium and small cities. So this product is for cities until 700,000 people. And this is like 90% of our cities, but they are smaller. And we consider first, if a city passes through a natural disaster like this, we consider that the whole economy was weakened. So we don't have to evaluate each case. So we are in a situation that we can provide a better response. And the funds that we need are very small over the last 4 or 5 years, but this year in 2023, we didn't have any incident. So we didn't need to use it. So in 4 years, we used just $20 million. Seems to be small, but for 3,000 clients over the years. And when we started in 2018, from that we have COVID crisis. So we adapted this product for COVID. And then we started to use for the municipalities too. So we have one specific product for municipalities. And we have lower rates in cities that has the lower human index level. So of course, it's not a profitable product in our, but we try to balance this with other products of the bank because it's a small one, but capable of providing a huge response for populations.
Great. So everyone be starting to think about your questions. I'm gonna get to do some of my own first. And one of them is somewhat targeted and all of you hinted at it, but and maybe I'll start with you, Jason, because you called it out, that there are really different barriers to see in underserved communities. So I think what's amazing about the Green Bank model is that you localize it, that you aren't just hitting a theoretical underserved community, but who is your local underserved community? You've talked about yours is different. So what are the barriers you see? How do you address them? And have you seen anything specific in programs you've launched that have been able to show you the progress that's being made? Jason, would you go first? Or are you frozen?
Oops.
Oh, no.
Oh, no, I'm here. Yeah, it's a hot topic here because especially as we've seen a lot of climate effects here, unfortunately, like so many other places in the last year or so. And the obvious has happened, which won't be a surprise to anyone in this room, which is that although storm events, for example, flooding events affect everyone, they affect underserved communities most, and those communities are least able to recover quickly. So those issues are becoming much more prominent here. So we, for some time, have had a lens of resilience in the work that we do. For example, in some of the infrastructure finance that we seek, and frankly, even in the investment assessment process that we undertake, we have a much more rigorous assessment of physical climate change risk in our long-lived asset finance deals in particular than we did even a year ago. It's as these issues have come to a fore, and we've really lived it. So in two of our transactions, one that was a grid connection asset, the one that I was speaking about earlier. It was delayed because of storm damage to some of the infrastructure in that area, and another transaction we have in the horticulture sector was delayed because of storm damage to some of those facilities. So these things are real, and we, as mentioned, have incorporated not only into our infrastructure due diligence assessment, but into our community engagement work as well. So it's something that we're dealing with probably more extensively and quicker than we even would have guessed a year ago.
It's not in the future anymore. Unfortunately, it is now for many of these things we have to deal with. And so I'll push the same question to you, Tricia, specific barriers you see in DC's underserved communities and how you've addressed them and, progress you've seen.
Sure, thanks. So I mentioned our work in solar, but we are covering the full spectrum, similar to Connecticut, Green Bank, New York, and so many of you in the room. We see an opportunity to continue to reach more of the underserved communities through solar and battery storage. So both distributed energy resources on rooftops and community solar, and DC benefits from a strong solar market and a strong renewable energy credit market. So the challenge is not so much that financing isn't there and there isn't an incentive to deploy. It's meeting the gap to ensure that we can really take advantage of the great programs that our district Department of Energy runs, Solar for All, with the DC Sustainable Energy Utility, and look at the trading regime under the renewable energy credits and the extension of the ITC, and then think about what's next. And for us, we're looking at the low income adder and, you know, the more targeted policy interventions that will help create the right market conditions to deploy capital at the least cost way to maximize the benefits through Justice 40. That's really kind of how we're thinking about anchoring it. There's a barrier to access, right? And there's a barrier in terms of creating the right capital products and the ability to bridge them through things like direct pay, for instance, with the investment tax credit, that we're trying to come up with the financial mechanisms to ensure that all of those great incentives and benefits that we're seeing, whether it's through state, local or federal policy or just in the capital markets, can be maximized to serve underserved communities. That's really our charge. And I think the challenge is on ensuring that we're getting 50% of the energy savings to those energy burdened households that Jahi mentioned, who are paying 3 times more than the average household for their energy bills. So how do you create the right pathways to deploy that low capital and create wealth? I think that's the challenge for all of us, but really an opportunity, and then matching that up with some of the building decarbonization work. So we provide financing for a whole range of affordable housing and green building retrofits and some new construction. There, you know, it was talked about in the prior panel, it's really hard to get at standardization. I spent a time working as an affordable housing developer trying to do green building retrofits for 70s multifamily aging housing stock. So there isn't a one size fits all or a decarbonization in a box solution, at least not yet. But I think there's a lot of great models that are out there that can be replicated. And so we're trying to identify some of those opportunities to bring the technical know-how with our partners in district government, community, alongside some of the opportunities to do like both carrots and sticks, as Bert was mentioning. We have a building energy performance standard in DC. So that can be the stick and can be a punitive penalty payment down the road, or we see it as an opportunity to bring it forward and incentivize building decarbonization where there hasn't been a ton of pent-up demand, and make those the policy environment create the opportunity set to deploy low cost of capital to do building retrofits paired with solar.
Wonderful. Maria, I will say you have a very different context. So a same question to you of how you're dealing with it in your context.
Yes, I think we have penetration through some partnerships, making a link with the last panel. So we have the local lender cooperatives, local credit cooperatives that help us. So at the same time that some incident happens, some disaster happens, we are actually at that moment on the place, and we activate a team to provide a response and to go to the local. But I would like to comment another thing. I am an infrastructure specialist. I've been working with public-private partnerships for 12 years. And there is a thing that is very hard to address some challenges when we are judging a project from the financial perspective, and we put them to check the boxes like, are you sustainable? Are you including the beneficiaries? Yeah. For instance, when we work with projects for waste management, we have to face the problem that that project are addressing the trash pickers that are working on the dumping site that will be closed. And usually the private sector can't and doesn't want, of course, but also it's very hard to include them on the process, on the new facility or everything else. And if you obligate them, you might have a problem in your contract, in the infrastructure contract, because you are saying too much about how it should work, and maybe this is the business. So how can we, as bank, say you should include the population, have the best practices? And most of the time, we don't have the answers on how they could do that. So we need to be a little humble, because sometimes the frameworks of sustainability are very extensive and comprehensive, but they are not looking at the detail of the context. So it is a challenge that I'd like to pitch.
So I want to pose that question to everyone afterwards, the how, but first, Bert, I'll pose the same to you, in terms of specific barriers and how you've addressed them and how you've seen them, the programs working.
Sure. Well, to go back to my introductory remarks where I said how our state was successful in terms of deploying a lot of solar. After a couple of years, we had come to the end of our solar fund, and we were doing an assessment and trying to see where we had been successful and maybe, kind of patting ourselves on the back. And what we discovered was, although we had opened the market and provided more access, there were still portions of our communities that were not experiencing the benefits of solar. And those were essentially those low-income, disadvantaged communities that were not getting access to clean energy. Some important reasons for that, some of them relate to being not being able to use the investment tax credit. You're low income, you can't use the investment tax credit. That is something that's very particular to the United States in terms of the benefits and how their incentives work. So if you don't have the income, you can't do that. So there was a need for new models or new approaches. And a number of people just don't respond in the same way to the same marketing techniques. And sometimes contractors just were not showing up in these communities. So they were going to where they knew they were going to be selling solar with ease, and didn't feel like going into these communities, feeling that, well, they don't want solar, they don't want clean energy, whatever. It couldn't be more untrue. So what we did, and Kerry was there at the time, we decided to do an RFP to try to find out who would be able to help us develop this market so that we could bring more access to these low-income communities. And through that process, Posigen, a company that was born out of the storm of Katrina, post-Katrina aftermath, and trying to deliver solar and solar hot water to communities in Louisiana, so in New Orleans, in that area. They were looking to expand. They put in a submission to us, won the competition. And at the same time, what the Green Bank did was a couple of things. Number one was we doubled the incentive for low-income solar access. And at the same time, we provided funding to Posigen, which was really just getting off the ground. You might have heard some more recent news where it's kind of hard to imagine that we've come so far so quickly. But we told them, look, stop looking for capital. We're going to provide you with the capital because we don't want you wasting time looking for capital. We're going to provide you the capital. You have tax equity with US Bank. We know US Bank, they provided tax equity to our funds. So we knew the structures, we were very comfortable, and our board supported us in providing the funding for them. And we did it in a way that said, we will be flexible and we'll be senior now, but we'll be prepared to subordinate if you can provide other sources of capital. And that worked, because then they were able to find more capital. We took a subordinated position, And then we were off to the races. But what was very important about Posigen was, in speaking about these contractors not going into the communities that were really missing solar, they established their headquarter operation in Bridgeport, a disadvantaged community. They went right to the heart of it, and they started hiring people there. And they started to really impress people. And one of their early customers, Susan Young, we all know her, love her. She's just an amazing woman. She was so taken by the benefits of solar, she became a solar diplomat, if you will, ambassador for the company, and started to, and now she's, do you know her role, Kerry? So
It was like head of outreach, right?
Head of
To-
outreach, yeah,
For
yeah.
the state.
Correct. And so it's just one of those stories where, yeah, you talk about, and I want to bring it to creating wealth. Many ways to create wealth. One of the ways that I think companies like Posigen create wealth is by bringing the jobs into those communities and hiring people locally in those communities. And that's one key way of developing wealth in those communities. So the Posigen model was one that took off because it was community-based marketing, and it was also an alternative underwrite. So it didn't look at FICO scores. It used other metrics to assess credit worthiness. So it was through that process that Connecticut, which was underrepresented in those demographics, became what we call a solar with justice state, where people at the 80% area median income, which is how we measure it, and below, actually were getting solar at the same or even slightly higher rate than those above. So it was really remarkable how quickly we turned that around. I think it took about maybe 2.5 years to accomplish that shift. And then more recently, that trend has continued. But what has also happened, and I have to peel behind the numbers for those at 100% AMI and above just have gone off the charts. So while the lower income demographics are getting solar more than they were, say, in 2019, those of means have just really, market has taken off. So, but we're still proud of the progress that we've made, and we continue that with. We have in our regulatory authority, and I want to get back to policy just for a moment, if I could, is that it's important that you lead on all fronts. So it's not only the capital, but it's also everything in statute that makes it possible, renewable energy credits and contracts and things of that sort. But also tariff structures are very important, and we're fortunate to have a regulator in Pura and Chair Gillette who leads that effort, who's really making equity and inclusion a key pillar of what the regulator is insisting upon from the utilities, who now have those solar programs. They've transitioned from the Green Bank over to the utilities. So those are the incentives that have been brought into the market. For example, for battery storage, they are very highly tilted toward low income, and that's to make sure that we get resilience benefits in these low income and what are called grid edge communities. So all of these possibilities are an expansion into low income communities are only going to be made possible by changing access through financing, but also having the right framework in terms of regulation and statutory authority to really provide the sticks to go with the carrots, as I say.
Yes, and this one's going to be to whoever wants to. It's kind of building on what the last two folks were saying. Finance is great and all, but it needs to improve lives, or what's the point? So how do you do that? How do you try and structure that into your deals where you're actually improving their lives? Obviously, building wealth is an example. It can be, improving health. There's a lot of different ways. So kind of to your question, how do you make that a part of your deals?
Well, I mean, I think where you see that a lot, Sarah, is, I mean, we'll take a couple of multifamily, at least one multifamily example. I think it was called East Meadow condominiums. And every time I see that video, I have to reach for a Kleenex because it's just, the stories about, leaking roofs and they wanted to take away the insurance or whatever. It's just a disaster of a condominium complex, low income, and what was happening is everybody was turning them down. All the banks were turning them down, wouldn't offer them a loan. Someone recommended that they talk to the Connecticut Green Bank. We went in there and we said, sure, we'll work with Capital for Change, CDFI. And this is another partnership that we do. And we said, sure, we'll put money behind it because why? Because it makes sense. You've got a leaking roof, but let's do solar and upgrades and everything like that, lighting, change out the lighting and everything else. And to just you go on our website and you'll hear these stories from people that we've done these transactions for, and it is transformative. They cannot believe the power of just improving your interior environment. So the air is now conditioned, meaning that it's steady. It's not wild fluctuations. And you're not sweating your brains out in the summertime and things like that. So it is transformative, but it also goes beyond that. It goes to the fact that a lot of these 40% of the greenhouse gas issues in our state relate to transportation. So we need to clean that up. This is one of the things that, again, back to policy, was passed in the last session, was to say, by the year 2030, 100% of school buses in disadvantaged communities must be zero emission. And by 2040, everybody's got it. But the emphasis was on low income and disadvantaged communities. So because that's where the impacts of pollution are felt most acutely, and asthma and chronic illnesses and things of that sort. So the benefits that we're seeing from addressing through the clean energy lens, these health impacts and the overlaps that we see are substantial. But we try to blend it in. I mean, we try to have an appreciation for all of the benefits we're going to see through our investment that way.
Did anyone else want to pop in on that one? If not, I can go to another one.
I would just add on, with buildings being for DC the largest sector that contributes to our greenhouse gas emissions, we are all in on comprehensive solutions that get at both reducing the energy burden for underserved communities, but also thinking more holistically about the co-benefits. So one example, we just, DC was awarded through FEMA bipartisan infrastructure law grant, $6 million for community resilience measures. And we designed that to be targeted at affordable housing. So you could do at the same time stormwater mitigation measures at hosts of affordable housing properties, and then fold in other green building retrofit opportunities at the same time. That's our intention, is to continue to bring those different policy tools and resources into communities so that you get the community resilience benefits of green infrastructure and avoid the walkaway problem we've seen for far too long with weatherization, where the basic home improvements and repairs don't get done. So our vision for really getting equitable electrification with building retrofits and resilience, and even better if we can get community or rooftop solar built into the model, but being able to target that as a health intervention and as a way to create a better indoor air quality and better outcomes for the district's families and our residents, but going at it in a way that also is promoting clean energy solutions. So I think all of us, the challenge, whether it's green building retrofits or solar deployment, is how do you twin these projects to avoid a lot of small incremental improvements over time, and really get to the heart of health outcomes that we want to see in our communities, paired with reducing energy burdens and addressing climate resilience measures that we know we need everywhere, and we needed them yesterday.
I'm hearing that theme too, that resilience is something that's hard to finance in and of itself on its own. But while you're doing other things, you need to consider it, or you're building something that's just going to be solar panels washed away, HVAC system, all that sort of, and as well, you were also talking about resilience. So I'm going to go to a question that came in online, and next I'll go in the room, but it's almost the same question I was going to ask. What are some best practices and information shared publicly when measuring your green bank's impact in taking communities ahead while maximizing return on investment?
I would rely on SDGs because BDMG has a framework for measuring how much of our financing is going directly through SDGs. And we have a third part that certifies us to make sure that's not SDG washing, quite the opposite. We are very proud of it. And I think that it's a framework for the future. We don't need to keep creating more things. SDGs are a good tool to analyze this. Just to take opportunity for the last question. At the other side, of course, creating health, we improve lives. But in my context, it's important to take them out of poverty. Years ago, we are talking about bags of poverty in some regions of our state, Minas Gerais state, that coincidentally are the driest region in the state, at the same time, the best region to capture and to have small farmers. So right now, BDMG has, we have, the numbers can be not exactly, but we are the bank that provides more financing in solar in our state. And that region that used to be a poverty bag, now it's it's showing and distributing opportunities for the population to have better jobs. They didn't have opportunities. It was quite remarkable when we traveled to those places. It was like, oh, today is Tuesday and we are on the street, it's 3 o'clock and people are not working. They are on the streets, like what they are doing. So we don't see this anymore. It's quite, it's very good to be able to tell you this story here.
Absolutely. I mean, and I think that goes back to the context. The green bank is so good at knowing local space and what the problems are instead of being. So are there any questions in the room we can go to? Yes.
Hi, my name is Idan Sasson. I'm with CDP, formerly the Carbon Disclosure Project. Work with over 1,000 cities, states, and counties on disclosure of mitigation actions, adaptation actions, and pending climate infrastructure projects. My question is to what extent your teams are coordinating with and how kind of local sustainability teams, CFOs of municipalities on the state level with states as to their mitigation, adaptation plans, and what role green banks can play in implementing the actions that they're seeking out to finance.
Well, okay, I was just going to say, we have a history of working with like environmental task forces around the state. Yeah, I think just about every town has one or has had one. I think they're all still operating. And so it's a very grassroots effort that's happened over the years. So we maintain those connections actively, and they're really our ears to the ground, in terms of what's needed locally, because that varies around the state. So yes, we're very actively involved with that process.
And at the DC Green Bank, we were created as an instrumentality of the District of Columbia. So inherently, we are, reporting into and supporting the mayor's and the district's decarbonization goals, and use the impact metrics that are tied to DC's sustainability plan to have, kind of that bi-directional relationship where we're reporting out on the outcomes, both on community impact and on carbon reductions, and we're supporting the mayor and the district's policy goals to get towards full decarbonization. So it's very much a tight collaboration and an opportunity to have more transparency and disclosure in terms of the strategies that collectively we're using to meet those goals.
Yeah, likewise here. The system's a little bit different because we don't have a federalist state system in New Zealand, but the what are called the local councils and regional councils here are large asset owners, so we engage with them quite commonly. So, for example, the Wellington Regional Council is the beneficial owner of one of the electric bus transactions that we did, and we engage with them also on a wastewater facility proposal, which ultimately didn't move forward. But that sort of engagement with local and regional councils is quite common here because of the role they play, not just in governance, but as asset owners.
Thank you, Sarah. Hi, I'm Rick Noguera, and I'm a senior advisor with Pollination, and I also sit on the board at DC Green Bank. We're very happy Tricia just joined us, even very, very recently. My question is about the private sector and how you engage or interact with the private sector. Typically, green banks have as part of their remit to mobilize other sources of commercial capital into their sectors. However, even so, when they're being set up, there's often a lot of wariness from the commercial banking community. They're a little bit nervous about who these public guys are going to be in our space, whether or not it actually is their space. It's a space they think they'll be in 20 years or something, but there's a little territoriality around it. So I'm just curious, what's been your experience? What works? What hasn't worked? What's the engagement like with commercial banks and trying to get them more active in these sorts of investments?
Well, let me just say it's a lot. It's evolved since when we opened our doors in 2011 and when I came in 2012. So, but one of the things we were intentional about was to bring in our local lenders, and then I'll come to the present. But we did that importantly in two ways. One, when we set up our solar fund, we decided to leverage it. So I'll say I decided to leverage it. Meaning I looked at the original structure and said, there's no reason why the Green Bank has to be 100% of these funds. This is perfectly normal consumer finance activity. Let's do an RFP and see what we get. And we had a number of banks come forward, and we ended up with what is now Key Bank and Webster Bank to co-fund that activity. And they're very happy, and they're still in it, and that transaction runs well. But what we did was we said, look, don't look at this as like you're putting the panels on the roof. This is a consumer finance activity. So what we did was we broke it down and we translated it into something that they were familiar seeing, which was consumer finance. And we sold it on the basis of a pooling of risk as well as underlying risk reserves to protect their position. So we got them very comfortable. And I mentioned the insurance product that we brought forward. So I said, look, number one, I'm going to protect the Green Bank, meaning we're going to use a structure to protect the Green Bank. And in protecting the Green Bank, we're going to protect you. So that got everybody very comfortable. The other transaction we did was with Smart E. And it was a change of approach because sometimes it pays not to be the first mover and maybe be a third or fourth or fifth or even seventh. But we took a lesson from New York and the struggles that they were having with their securitizing their loans. And we said, we don't want to do that. Let's figure out a different way rather than investing green bank money and then trying to figure out how to get green bank money back. Maybe we can skip a step and make sure that these loans go to community lenders that actually want these loans on their books. And so what we did was we actually rolled up our sleeves, looked at all the credit unions and said, who's got the most exposure in treasury bills? And we went after those candidates and said, wouldn't you like to lend to the homeowners in your neighborhood with solar and energy efficiency? And instead of earning 10 basis points in treasuries, which is what it was at the time, we think back there.
A little different now.
Yeah, a little different now. But earn 500 basis points. And so it got their attention. They said, well, we'll make it easier for you because we'll provide a loan loss reserve. And all you have to do is use not to exceed rates. So it's a good deal for the homeowner and push out your maturities. So this is really unheard of, but we kind of prodded them into changing their approach. So we got this buy-in, and $140 million of underwritten loans, and going across the nation with IPC, that's how we work. What's happened more recently is the banks are really hungry for this activity now. So it's on their screen. They want to do ESG. And so now they're coming to us and saying, do you have more? Do you have more? Do you have more transactions that we can be involved in? So we have to get creative and think of new transactions and on a local scale, because offshore wind, you don't need the green bank to be involved in that. Although there is a twist, which is coming about with Title 17 being adjusted and state energy financing institutions getting around the requirement in Title 17 for innovation in order to bring in federal financing. So now we're coming back in the picture, whereas before, you didn't need a green bank, maybe in offshore wind transactions. Now maybe you do, because that helps you get treasury financing at 30-year treasuries plus 3/8, and that's attractive money. And when midterm treasuries are at 5% or 4.5% to 5%, and you got to throw a spread on that and everything else. So it's changing in terms of what the market's kind of looking for and how they want us to participate. And how we've done it over the years is we love being mezzanine because we think that that's an easy way to leverage people into the market. And that's proven to be a very effective tool. So it's we just have to adapt in terms of what the market is looking for. We also have opened up a portal like New York Green Bank started with its RFP program. We took a page out of their playbook, as well as Clean Energy Finance Corporation in Australia. This is how we kind of learn from each other. And we established what we call capital solutions. So we put it out there so that sponsors can come to us with their ideas. And all we say is, look, it's got to be impactful, and we don't like to do one-offs. So make sure that you can do it again and again, and come talk to us. So we've had a number of transactions come through that portal already. But that's pretty much how we're trying to interact with the market.
Wait, is there anyone else that wanted to, or we have time maybe for one more question? Or Jason, I see you.
I can comment on that if you like. So I would say a couple of things. And Rick, nice to hear your voice. One, part of our mandate is, in fact, to always seek to crowd in private capital into the work that we do, again, by mandate. So we have a lot of flexibility around how to do that. Sometimes we bring other investors into our opportunities from the very beginning, and sometimes we explicitly say, no, we'll bring a project or a company even up to a certain level of maturity and then bring other investors into it. But to answer the question more directly about whether we find ourselves competing with the commercial banks in this market, the answer, believe it or not, is not really. And there are a few reasons for that. One is that we don't act in the retail space like Bert was speaking about. And the work that we do is much broader than the commercial banks here typically do. So if anything, sometimes we face the opposite problem. Some of them have put sub-market rate loans into the market to gain market share into small and medium-sized businesses for their green initiatives, crowding us out from some of those opportunities, ironically. But more broadly, the culture we've developed in our organization is to always seek to work with those entities rather than, against them or anyone else. So one great example I like to talk about is that we were working with a solar operator in this market called Solar Zero that had a relationship with one of the main banks here as senior lender, who had happened to essentially be tapped out on credit to that particular business. And in our conversations with the both of them, we said, well, we're willing to come in, a bit like Bert was talking about, we're willing to come in as subordinated lenders. And that allowed the senior lender to increase their lending and obviously provided more capital for the business. And really everybody was happy. So that's the model and certainly the mindset that we always use in engaging with other actors in the market.
Great. So we'll do one short question. If you can be short.
Sure. This is related to your relationship, with commercial entities, investors. So to mobilize private capital, would you be considering opportunities to kind of issue debt or bonds, whereby, something like resilience bond, whereby, very in a targeted way, you can raise a private capital through your green banks?
And if the answer can be short, because this is
Sure.
between us and some drinks outside.
Yeah.
Just throwing that out there.
Okay. So yes, we've issued bonds. We've issued over $100 million of bonds. More recently, we've innovated with the Green Liberty Bond that's available for $1,000 issuance level. And then we've also innovated with our Green Liberty Note, which is $100 entry point and is available on the Raise Green platform, which is on the other side of the table. And we do that every 3 months. So we've been intentional about the way we've issued on their platform. Typically, they have issuances that might come once or twice in a 3 or 4 year period, except with NEIF. I know that they're a regular issuer. But when we went to Raise Green, we said, we want to be there every 3 months with a CD-like product. Now, why is that important? Because that keeps the green bank in the market all the time. Mm-hmm. So if we want to issue a resiliency bond, so instead of a 1 year note, now we're issuing maybe a 5 year note or something like that. We can do it. We can now turn that lever on. But we have a mechanism that's well established and we're a known commodity in the market. So that's how we're playing our strategy here.
Very interesting.
Well, wonderful. Well, first I want to just really thank everyone